Imagine a world where your hard-earned money stays in your pocket, empowering you to build a prosperous future. This is the reality for savvy real estate investors who master the art of reducing taxes legally. Let's dive into how they do it. At the core, real estate investors leverage tax laws designed to incentivize property investment. The government encourages individuals to own and maintain properties because it supports housing needs and boosts the economy. Key strategies include deductions, depreciation, and tax-deferred exchanges. But what does all this jargon mean? Simply put, it's about using legitimate tools to keep more of what you earn. Take depreciation, for instance. Investors can deduct a property's depreciation as if it were losing value over time, even if the real estate is actually appreciating. This paper loss helps reduce taxable income. Picture a rental property bought for $300,000. The investor might claim depreciation of around $10,000 annually. This doesn't mean the property's value is decreasing by that amount, but it does mean the investor pays taxes on $10,000 less of their income each year. Let's bring this to life with an example. Meet Sarah, a real estate investor with a keen eye for opportunity. She owns a few rental properties and has learned to navigate the tax landscape skillfully. Last year, Sarah bought a small apartment building for $500,000. By applying the depreciation method, she wrote off about $18,000 annually from her taxable income. But that's not all. Sarah also capitalized on the 1031 exchange. This strategy allows her to defer capital gains taxes by reinvesting the proceeds from a property sale into a similar investment. When Sarah sold her first rental property, she smartly rolled the profits into another real estate deal, postponing her tax payments and amplifying her portfolio growth. Tax deductions are another ally. Sarah deducts expenses like mortgage interest, property repairs, and even travel expenses for property inspections. These deductions further shrink her taxable income, lightening her tax burden legally and effectively. For example, if Sarah spends $5,000 on property improvements and $3,000 on mortgage interest in a year, she can reduce her taxable income by $8,000. The wisdom to take away here is that the tax code is not just a rulebook, but a roadmap to wealth if navigated wisely. Real estate investing offers unique advantages, allowing investors to grow their assets while minimizing their tax liabilities. However, it's crucial to remember that tax laws are complex and subject to change. Consulting with a knowledgeable accountant or tax advisor ensures that these strategies are implemented correctly, staying within legal boundaries while optimizing financial benefits. In the end, the key takeaway is that understanding and utilizing these tax strategies can transform the way investors build wealth. It's not merely about owning property. It's about strategically managing assets to maximize returns. By engaging with the tax system intelligently, investors like Sarah can maintain more of their income, reinvest it into their burgeoning portfolios, and continue to fund a future that aligns with their financial dreams. Embracing these strategies opens a world where financial growth is sustainable and prosperity is within reach.